We're talking about these recessions, and tell us why we should not worry.
The reason you shouldn't worry is what we like to tell people is that there's no good or bad news. There's just news. It depends on what position you are in, whether people interpret it as bad or as good. And so right now what we're doing is we're giving you practical applications of what you can do to get yourself in a position that if market changes, real estate and or stock market, that you're in a position to act. And the biggest thing that you're going to find is, Nelson Nash talks about this in his book, is when you get into a position of cash is you see things differently. Just like Anthony talked about before, we pulled his lines of credit, he was in a cash-rich position. Now he had peace of mind. And now if external factors change for us, now we look at them as an opportunity to move into. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today what we're going to be talking about is the upcoming recession, things that you can do about it, and why you shouldn't panic.
I'm excited for this.
Me too.
And Cameron, how did this all start, right? What's triggering this episode?
Well, honestly, we've had a few phone calls. Right, we've had clients that have called in and are concerned and worried about a potential recession in the short term, like in the next month or so. And so Anthony and I have been talking, and you know what? If we've got clients that are calling in, we're sure that more listeners have that same concern. So what we've done today is we're going to talk a little bit about that, and we're going to give you some practical solutions as well.
Perfect. And one thing that's kind of why we're expediting this, because this is October 8th, and we're going to put this post this on the October 12th, right? And the reason why this urgency is coming from a tweet by one of the people that we look up to. Yeah.
By Robert Kiyosaki. And recently he just tweeted, and I'm going to read it here. We'll put it on the screen for those that are watching in the video. But for those that are listening, it says, "The giant stock market crash coming October. Why? Treasury and Fed short of T-bills. Gold, silver, Bitcoin may crash too. Cash best for picking up bargains after crash. Not selling gold, silver, Bitcoin, yet have lots of cash for life after stock market crash. Stocks are dangerous. Careful." Anthony, what are your thoughts when you hear something like that from Robert Kiyosaki?
Well, the first thing that jumped out to me was October.
Yeah, right? He puts a timeline on it.
Yeah, because you know what I found, and we're going to talk more about the history of recessions, but everybody says recession is going to happen next year. Okay, next year goes around, and it's next year. And honestly, I think we have to put ourselves in that.
Yeah.
I mean, we're talking about why in a minute here, but we've been touting that there's going to be a recession probably for 6 years.
Yeah.
Right. And sometimes I feel like we're crying wolf. Hey, there's going to be a recession, but then the stock market goes up.
Yeah.
But here's what I think is going to happen is the government with their policies are inflating the economy. They're propping it up with, you might have heard the quantitative easing, or where they're buying these bonds, literally creating money out of thin air. And if you look at the chart of the bonds they've purchased and when they've stopped and lowered, and then you overlay that with the chart of the S&P 500, it's the same chart.
Yeah.
Right? When they eased down the buying, the stock market stayed down. When they started tempering down, the stock market went down. And then people panicked, so they bought more bonds. The stock market went up. So, but what I believe is happening is, we're more of a free market.
Yeah.
Capitalists, that the free market will decide. And when there's artificial triggers like the government getting involved, that's what creates these booms and busts. And the longer the government delays this recession, the harder it's going to hurt. Right?
Absolutely.
Now let's talk about these recessions.
Okay.
Right? Because again, I want to explain why we've been saying, "Hey, recession's coming," but it hasn't.
Yeah.
So what I think would be cool again, I'm a nerd, right? So maybe
it-
not everybody think that this is cool,
Yeah.
but what we've looked at is through Wikipedia, and they've listed every one of the of the recessions. We're going to put a link in the show notes. Okay.
Awesome, Anthony. Let's go back. Let's start looking at this Wikipedia list. Let's go back to, let's start 1900s.
Okay, so you're going back 120 years.
120 years. Let's go
Okay.
through this, right?
Okay.
Is Anthony, was there a recession in the 19 to 1910?
Check.
1910 to 1920.
Check.
1920 to 1930.
Check.
That's a big check, right?
Yeah.
1930 to 40.
Check.
Yeah, another big one. Now 40 to 50.
Check.
How about in the 50s? 1950s.
Check.
1960s.
Check.
1970s.
Check.
1980s.
Check.
1990s.
Check.
2000s.
Check.
2010s.
Check. Whoop. Wait a minute. No. No, there wasn't. You caught me here.
I did, right?
Right?
Yep. I was going too fast for you. You got to keep up. So this is the reason why, right? You go back and you look at this. There's definitely a pattern. And as Anthony had just mentioned, there's a reason why there has not been kind of a recession here in this last decade.
Mm-hmm.
And it is absolutely due to quantitative easing and the government pumping money into the economy. And not only are they pumping it in, man, but it is in overdrive, right? I think you've seen stats and everything else. A third of the money supply has been created in the last 2 years, something crazy like that, right? So, Anthony, that's why we think that it's coming. What are some things that, give me one thing that our listeners can do to prepare for some of this?
What I would be looking at is if you have some assets that are volatile, that are going to be subject to the market. For example, maybe you have an investment account or your 401k or IRA.
Mm-hmm.
I think now would be the time to start getting out of the stock market and getting that into cash.
Mm-hmm.
And you know what? Could the stock market go higher?
Maybe.
Yeah. Could it go lower?
Certainly.
Right. So there's obviously a chance that it could go higher, but it's more than likely to go lower.
Yeah.
So by moving those off, you might miss a little bit of the gain, but what you're also going to miss is a crash.
Yeah.
Right. And so, but one thing we want to make sure is with this recession coming, it's nothing to be scared about.
Yeah.
Right. Because if you kind of can get prepared for it, you can turn that into an opportunity. Because in that case, let's say you can't take the money out of the 401k, right? Because you still work there. Well, let's maybe move some of that into cash. And then after the crash, that's when you go in to buy. Because what I believe, and I've been saying this a lot lately, is that the economy overreacts.
Mm-hmm.
When there's good news, everybody's buying, right? And they're inflating the price. And I think you can see that in the stock market and even in the housing market right now. But then when on bad news, we also overreact. When people start selling, everybody starts selling. And so that's going to create opportunities, all sorts of asset classes, not just the stock market. Cameron, what are some other things that we can do for this pending crash?
Yeah, we've got a few, but one of them that I'll add here is one of the things that you can do is certainly delay buying any sorts of liabilities. Mm-hmm. And again, we subscribe to Robert Kiyosaki's definition of liabilities is anything that takes cash flow away from you. So buying a new car, buying a second house, something like that, right? Oftentimes people are considering these types of purchases, and man, right now would be a great time to maybe defer or delay that purchase.
Mm-hmm. Perfect.
Yeah. Anthony, what else? What else can they do?
Well, Ted, this one I'm very passionate about because I kind of incorporated this when COVID first happened, is now's the time to apply for loans. Mm-hmm. But again, I'm not meaning like a car loan or to buy a loan to buy a liability. I'm looking for lines of credit. I think a lot of business owners didn't know that you can go to the bank and you can get a business line of credit. Now's the time to get a home equity line of credit, particularly now, because I always like to say banks will loan you money when you don't need it. So if we wait 6 months or whenever this recession happens, the banks aren't going to loan it to you.
Yeah.
You need to ask for it now when you don't need it. Hopefully you may never need it or use it. But one thing I will say is when this crash happens, what banks can do, and this is what they did in '08, they can freeze those lines of credit. That's what happened to my HELOC. That also happened to one of my business lines, the business lines of credit. So what you can do is, or when this happens, what I'm going to do, I'm going to pull on those lines of credit because I want to make sure I have access to that capital.
Yeah.
Because, again, I'm not panicking, and I'm hoping that there's going to be some assets that I can buy. But what happens if things are really bad and I need cash?
Yeah.
Right. It's going to be too late to ask for it. So, like what I did when COVID first hit and the banks started closing, like I panicked. So I went to the line of credit and I withdrew 95% of it. I didn't want to do 100 because that kind of sometimes scares banks, right? So then I had this cash, and then the next question is, what do I do with it?
Yeah.
I mean, I'm a little concerned about storing it in the banks because a lot of banks failed in 2008.
Yep.
And without getting too much into it, part of the bills Congress passed is that so they're not going to bail out banks anymore. If anything, they called it a bail-in, which means if that bank fails and the FDIC runs out of money, which they don't have a lot of money compared to the assets that they're backing up.
Yeah.
The government's saying, hey, you can't come to me. You got to stand in line just as another creditor at a bank. So what I did is I put it into one of my policies. And that's one of the many reasons why with my policies, I don't pay all the loans off. I always want to keep a space open for windfalls. So what I did is I just took that money and I just stored it into my policy. So at least this way I had access to it. So if I needed it, I can get it. And then when things settled down, I just reversed it and took a policy loan and paid off the line of credit. And I will tell you that interest rate, I don't care what it was.
Yeah.
Right? Because it's not about the rate. I needed access to liquidity, not just for opportunities, but also
Peace of mind.
Peace of mind, right? It's hard to put a rate on a peace of mind.
Not really. Just ask a bank; they'll give you a rate. They'll assign something to it.
All right, Cam. So, what else? Or what are things that we can do?
Man, you hit a good point, right? Is we're going to pull kind of lines of credit, and what you just referenced was putting it into a policy. But man, another option, right, is also to actually have cash and or gold on hand at your house, right? So what I always tell people with gold and cash, right, as far as like gold being a currency that somebody's going to trade, is always a spectrum of like chaos, right? Some people call us and they say, hey, I think the world's going to end and the monetary system's going to be over and we're all going to be operating on gold, right, at that point. Okay, fine, keep some gold at home. But typically what people are talking about is having cash on hand in case the banks go down for a period of days or weeks or something. And at that point, you do want to have cash on hand, typically probably some smaller denomination bills. And, you got to keep it somewhere safe. And so along with that is have it in a safe with a very large gun, right? Right next to it with lots of ammo. But one of the things that, we always tell people, or at least I've heard, is that you'll sleep better at night just having access to capital and cash on hand at your house. So it's a great opportunity to kind of pull it out. We just had a client call this the other day and was asking about this. And the advice that I gave her was, man, cash it out. put it in the safe at your house and just wait until everything kind of subsides. If we need it, great. If not, then we just stick it back in 30 days, 40 days.
Exactly.
Yeah.
And I guarantee you there's some listeners out there, and I was the same, where I wanted to have some cash at the house. I wanted to get a safe, wanted to have a gun, but I just kept putting it off.
Oh, good point. Yeah.
Right? So now's the time to stop putting it off.
Mm-hmm.
I will say we finally, because I was storing cash for a while, like in secret hidden spots, right? I'm sure no burglar would ever find it.
Yeah.
But then we eventually, we got a safe, and we drilled it down into the floor. And I would tell you the coolest part.
What?
Is like, it's not that large of a safe, but the dial, it has that circle where you got to use both hands, and it makes, every time I open it, I'm like, oh man, I've made it.
Yeah.
Like I have this cool safe. But what I just want to reiterate, give you guys a nudge. If you've been putting off storing some cash, getting a gun, now's the time to do it.
And lots of ammo.
Yes. Yeah. Ammo.
Awesome, Anthony. All right. So cash, gold at the house. What else? Give him another practical example.
If you're paying extra principal on some loans, just stop. Right? I see a lot of people doing it on their mortgage, and we've had plenty of podcasts on our philosophy on a mortgage, but whatever that debt is, right now we need to have liquidity.
Yeah.
And the problem, there is an advantage of paying extra on those loans, because then we can pay them off sooner. We're paying less interest. Totally get it. But we're just looking at the math, right, on paper on there. What we need to look at is we need access to cash. And when you make that extra payment on that mortgage, you can't get it back.
Yeah.
Unless you ask for permission.
Yeah, I'm not big on that.
Right? And if you want that money back, or you need that money back, you're probably not in a position where the bank's going to loan it to you.
That's right.
Okay. So worst case, take that money, put it in a savings account or in cash, and then when things settle down, then go ahead and take it and pay it towards that loan, if that's what you want to do. And in all practicality, what we're looking at, that small amount of interest that you're saving, I don't think it's going to be worth the opportunities and the stress that you could be saving.
Agreed.
Now, one thing I'm sure some people are asking, well, if or when there is a crash, how's that going to affect my policies in the insurance companies? What would you say to that, Cam?
Good question. First, what I would say is, if you look at the insurance companies that we do business with, right, that we have policies personally and with our clients these are some of the oldest mutual insurance companies that are around, right? They've been operating for 150 years plus, and they've been through that list of recessions that we just went through, right? They went through the recession of the Great Recession. They went through the last pandemic of 1918. They've been through it all, right? And so they are not affected by these kind of short-term fluctuations in the market. And the reason for that is because on their books, if you look at what insurance companies actually invest in, is it's very high-end commercial real estate. And then it's also the bond market, but it's the 30-year bond market. And we actually have a great interview, a podcast that we did with one of the executives from one of the major mutual insurance companies that we do. And right, my takeaway from that conversation was he essentially said, hey, listen, these little short-term blips don't affect us. He even went to the extent of saying, hey, these long-term low interest rate environment really doesn't affect us. And the reason is because their investment portfolio, their timeline, is in these 30 and 35-year blocks, right? And so they still own bonds from 25, 20, 30 years ago that are performing at much higher interest rates than they are now. And so the turnover that they have on those is so far between that it really doesn't affect them. And so insurance companies, for better or worse, are very static. They're very boring. They're very consistent. And if you look at your actual policy, inside of there is you have guarantees. And so there's a contractual obligation inside of that policy for your policy to increase next year and the year after that and the year after that. And what I think is really cool, I don't know if I've mentioned this before, but we always talk in terms of percentages. But if you actually go in there and dive into a policy, that guaranteed column is actually represented as a dollar amount. So I always thought that was cool, is because it's not 2% of some random variable number. They're showing you a dollar amount that policy is going to increase by. And so when you're looking at places where you can put money, cash value, life insurance with a mutual company is hands down one of the best places that you can put cash.
Yeah, in 2008, 499 banks went under.
Mm-hmm.
Cameron, I know you know this number. How many mutual life insurance companies went under in 08?
Zero,
right? They were
same number of times you were asked out on a date in high school.
Dang. Wow, that was low. That was hurtful and true at the same time. Okay, but in addition, again with infinite banking, this is an and asset. Let's store that money somewhere safe and liquid, so when these opportunities come, and they are going to come, you're going to be in a position to take advantage of them.
Mm-hmm. When you're not in the market, right? You're not subject to the market. So when you're out of it, now it just becomes an opportunity, just like other investment is. You're buying it on sale, right, at a much lower discount. So
we're talking about these recessions, and tell us why we should not worry.
The reason you shouldn't worry is what we like to tell people is that there's no good or bad news. There's just news. It depends on what position you are in, whether people interpret it as bad or as good. And so right now what we're doing is we're giving you practical applications of what you can do to get yourself in a position that if market changes, real estate and or stock market, that you're in a position to act. And the biggest thing that you're going to find is, Nelson Nash talks about this in his book, is when you get into a position of cash is you see things differently. Just like Anthony talked about before, we pulled his lines of credit, he was in a cash-rich position, now he had peace of mind, and now if external factors change for us, now we look at them as an opportunity to move into.
Well said.
Well, thanks.
You know, I'm going to talk, what I mentioned before is that we have in general, we overreact.
Mm-hmm.
So these assets too many people are going to sell, which means there's going to be opportunities.
Yeah.
And one thing I like to say, I know I've said it many times on here, and it's not derogatory towards you, but
I thought it was.
The bigger the opportunity, the smaller the window to take advantage of it. And there's going to be opportunities. Some obvious ones are going to be maybe in the stock market, right? But and or the real estate market. But if you're a business owner, this could be a great time for you to expand. Mm-hmm. Maybe you buy a competitor, or maybe you buy some equipment because somebody else went out, or maybe this is a time where you renegotiate your lease and you expand, or maybe you buy a commercial building. Right? But in order to take advantage of those opportunities, you need to have access to capital. And as long as you can do that, you can take advantage of those opportunities. And, you know, I used to say this when Game of Thrones was really big, right? But the whole theme on there from the whole show is winter's coming. Mm-hmm. But in that fictional story, like winter could be like 5 to 10 years, right? So winter is coming. This recession's coming, and that's okay. If you prepare for it, you can have your winter coat. You can have your food supplies, have everything you need, so you can actually thrive during winter, during this recession. So when this ends, you can come out bigger and better. Because to me, it frustrated me in 08 where I saw people buying these assets for 50 cents in the dollar. Mm-hmm. And I was not in a position to take advantage of it, and it pissed me off. Mm-hmm. And I told myself, especially when I saw there's a recession literally every decade, this is not going to happen again. The next time winter comes, I'm going to be there with my winter coat and my earmuffs
And mittens.
and I'm going to have gloves, man. Or as long as my fingers are cold, because I can't stand my fingers are cold. Mittens or gloves, I'm going to be there getting my hands dirty, growing my wealth, and growing my passive income.
Well said. And to wrap this up, I'm going to quote the famous philosopher Nelson Nash. If you know what's happening, you'll know what to do.
Well said.
Thanks.
Well said. Go make it a fantastic day.
Take care.